Hello everyone, and congratulations on making it through Chapter 3 on deferrals and accruals. Those concepts of deferring revenue or deferring expenses, accruing revenue or accruing expenses, all those part of the adjusting process, are critical and foundational to understanding accounting. And if you do get it, as I said in the announcement for this week's work, if you do get that, it'll be much easier to understand some of the more advanced concepts that we're going to go over later in this course and in Accounting 251. What I'm going to do now is share a PowerPoint presentation on Chapter 4. Some of it will be a repeat of what we had in the Foundations video lecture earlier, but I think you'll find it helpful to augment your learning of Chapter 4. Okay, let's go through some slides about the closing cycle. This first slide you have seen before in the previous video lecture where we talked about accruals. And it's an illustration of how the balance sheet is a point in time. So you start with your beginning balance sheet, which the last day of the previous fiscal year becomes the first day of the current fiscal year. And there's your accounting equation, assets equals liabilities plus equity. And during this period of time, and we're using a 1 year period here, you will have an income statement which shows revenue minus expenses equals net income, and that is closed in a corporation to an account called retained earnings. So the net income would be added to the beginning retained earnings balance to get to the ending retained earnings balance. And remember, in your book, instead of a corporation, you're talking about a sole proprietorship, so you have one owner's capital account, and that owner's capital account then receives the benefit of this net income for the period. In this illustration, there's some net income for the year, which is $16,960. I said for the year, excuse me, it's for 2 months actually, and so it would be for the months of November and December to get to the end of the year, December 31st. So for this 2 months, they earned almost $17,000 of revenue, had $9,855 of expenses that are all detailed here, and then expenses subtracted from revenue gives you the net income of $7,105. Now they're showing this flowing to the statement of owner's equity, and we're going to get to the statement of owner's equity after this next slide, where I want to remind you of what those 4 basic financial statements are. It's really the 4 only financial statements. The balance sheet and the income statement we introduced in the previous video lecture, and those are the 2 most important, 2 most common financial statements that you'll see. Big distinction being balance sheet is an as of date, and it shows the permanent accounts, assets, liabilities, and equity. Income statement being a period of time and shows the temporary accounts of revenue and expenses. Now the other 2 financial statements, the one we're introducing now, is they are also for a period of time, the statement of changes in owner's equity and the statement of cash flows, again both being for a period of time. What these show are simply the changes in specific line items on the balance sheet. And as the name implies, the statement of changes in owner's equity is dealing with this piece of the balance sheet right here. What happened during a period of time to owner's equity? And we'll see that one of the biggest things that happens is a net income or net loss during the period. Statement of cash flows, you don't need to worry about this now. You're going to worry about it quite a bit in Accounting 251 when you get to that next class. Or that next course, excuse me. And it shows the changes in cash, which is only a piece of assets. It's only the first asset you list, but it's extremely important because cash is king. And how did cash go up or down during the period? And basically you separate it between operating, investing, and financing activities. Don't worry about this right now. It's a major component of your next course, and it's a very important statement. So right now we're only dealing with this statement, the statement of changes in owner's equity. And the first item, obviously, you begin at the beginning, and that would be the beginning balance in owner's equity. And continuing the illustration, that's that $7,105 of net income that we showed a couple of slides back. And the beginning balance here, since we're only doing 2 months, remember, so they're starting with November 1st, adding the net income for that 2 months, and this owner drew out $4,000 from the business. And so you'll see that you're adding the 7,100, you're deducting the 4,000 to get to the ending balance of 28,105, and you'll see that then presented on the balance sheet as of the end of the year. And there's your 28,105. And of course, assets equals liabilities plus equity. A classified balance sheet is simply where you're taking your assets and your liabilities and you're saying which ones are current, which ones are long-term. And we'll talk about the current right now. Current assets are the highly liquid assets, and basically you're saying that they're going to be converted to cash, used up or converted to cash within 1 year or within the cycle of the business, whichever is less. Most businesses complete what you'll call a cycle, which is basically the if you're in the business of manufacturing something, so how long it takes you to get the raw materials in place and to create that item, and then for that item to go through inventory and be sold to customers, and then come back around to cash, and then that cash is again used to buy more raw materials. So that is a cycle, and as I said, most of the time that's completed within 1 year. Some examples of current assets are cash, that's obvious. Accounts receivable, here you're expecting to collect from your customers within a year, and most of the time a business has terms of net 30 days where you expect customers to pay fairly quickly. Notes receivable, if you happen to have, that's a little bit like accounts receivable, it's a little more formal, and so maybe you'll have a 90-day note receivable, but that would be a current asset. And of course your supplies and inventory also would be another example. Fixed assets are really a type of long-term assets, but in the introductory course here, we're only talking about your plant and equipment. And of course land is also considered a fixed asset, but remember, land is not depreciated. It's considered to have an indefinite life, so you don't depreciate what you pay for it or its original cost. So examples are equipment, machinery, buildings, and then there is land. And again, these are all long-term assets. Current liabilities are liabilities that you expect to pay. Remember, liabilities are what are owed by the business, and you expect to pay those within a year or within the current cycle of the business. Examples being accounts payable, wages payable, interest payable on any debt, and any unearned fees that you may have. Remember, unearned fees that's unearned revenue. So if a customer pays you in advance, and what you're going to then have to do is earn that revenue. They paid you up front, but you now have to complete that earnings process. As you do, you will amortize or reduce that unearned revenue, which is a liability, and you will then earn it. Long-term liabilities are things that you're going to pay longer than a year. Of course, in our personal lives, we have examples like this with our mortgage. There it comes, and of course, a car loan could also be the same. Now, a piece of that, obviously, you're going to have due within a year, but then the rest of it would be considered long-term, what's beyond 1 year. And bonds payable. Again, bonds are another topic that we'll get into in Accounting 251. So that's I love teaching bonds, so get ready for that. A little more complex in some of the things you're learning. But of course, you'll know bonds payable, it's a liability, therefore has a credit balance. Going back to owner's equity now, it's the right to the assets of the business. And of course, when you say it is added to liabilities, and that combined total must then equal the total assets. Owner's equity, there really are two things that you need to think about. It's that original contribution. In a sole proprietorship, that owner is injecting money to get the business started. It takes money to make money, remember. In a corporation, they will issue shares of stock on the open market, such as New York Stock Exchange or NASDAQ or some of the other exchanges. And so therefore they're publicly traded because those owners are in the thousands possibly. It's whoever owns the stock in that company. So that injection of capital into the business is one component of owner's equity. But the other component that we'll talk about again before we close out this slideshow is the accumulation of the net income or net loss since the business started. and that's called retained earnings in a corporation. And of course, with a sole proprietorship, it's just part of the capital balance and how that changes over time. The concept of closing entries are really not complicated, and I apologize because the way accounting is being taught to you is the same way it was taught for decades ago, and that is before the advent of computers and all the automation. There were a lot of manual entries that had to be done to close the books, if you will. And now that is all done by the computer. It's done behind the scenes, and these entries really are not made to the books per se. But we're teaching them in that fashion so you can get that mental model, and it basically depicts what's happening in the algorithm of the computer of the accounting system to accomplish that close. What you already handled in Chapter 3 and all the adjusting entries that you had to make, that's the real difficulty and the real problem. And so now that you've mastered that, this closing business is not a big deal. So what are we talking about here? We're talking about closing those temporary accounts, which were the revenue, the expenses. The drawing account is like an expense, but it's something that's closed straight to equity, and it doesn't appear on the income statement. An income summary then, in religious terms, we'll call it purgatory. It's basically a holding account, and you're going to close out revenue and expenses to income summary, and then income summary in turn is going to be closed out to owner's equity. The drawing account, if the owner of the business took some money out, that's transferred straight to the capital account, and it does not flow through through the income summary. And then again, those closing entries are what transfer the revenue and expenses to income summary, and then you transfer income summary to owner's equity. Now, if you want to strap in your seat belt here, I'm going to exit this mode and continue recording here. Let me expand this a little bit, because what I want to do now is do a little bit of drawing for you. So bear with me, and we'll see if you can see my cursor now. And so here we have income summary. This side of it is the debit side. This side is the credit side. It's kind of acting up on me here. Assume C stands for credit. So if over here we have a T account, and we'll call this our fees earned. Remember, revenue has a credit balance normally, and let's say we earn $6,000 in fees. So there's my credit. Now I have to make a closing entry to this revenue account called fees earned, so I will have to debit fees earned for $6,000 in order to close it out. This debit to fees earned is also then going to be credited over here to income summary. Now let's say that I have an expense for my business, and the only expense that I have is wages. The normal balance of an expense account is a debit, and let's say that's $4,000 of wages. Debit's on the left of my T. The closing entry that has to be made, if I want to close out an expense account that has a debit balance, I must credit that account to close it to zero. This $4,000 credit closing entry to wages, the debit side of that entry is going to be made on the debit side of income summary. So again, a debit here, a credit here to wages, a debit to income summary. The debit closing entry to revenue is a credit to income summary. Then look what happens. I have a net balance of $2,000 in income summary. That would represent my net income for the period, and then that has to be closed out with a debit, and then that credit would be owner's capital. Let's assume that's a T account down there. So as I debit income summary, I will credit owner's capital. So it caused it to go up or to increase during the period, and then I'll take a snapshot at the end of the period to get my balance sheet. So let's exit this mode and go into presentation mode. So there we call income summary a temporary account, or that's that purgatory. It's a holding account, and it's going to obviously then go to owner's equity, or at the end of the period. And there we say that the income summary will have a zero balance when it's closed to owner's equity. Hence it's called a clearing account. This is another way to illustrate what I crudely drew a while ago, and that is all of these expenses are listed right here: wages, rent, depreciation, utilities, supplies, insurance, and then miscellaneous. And they all had a balance that was a debit balance. And then all of these credits that you're seeing up and down this line, all these credits here aggregate to $9,855, and what you're doing is you're crediting expense and debiting income summary. That's the closing entry for expenses. I show my revenues over here. They all had credit balances, credits on the right hand side of the T. They had to be debited here, which both revenue accounts were debited for $16,960, and I credited income summary for that amount. Now income summary has a net credit balance, the $16,960 that came from my revenues, the $9,855 that came from my expenses. The net of those two numbers is the $7,105 that is now going to be closed to owner's capital. And remember, that was $7,105 was the net income for the 2 months. We're showing down here the 4 steps in this closing process, and the illustration that we're doing here that on the expenses is to debit each revenue account for its balance and credit income summary. And then you debit income summary for the expenses and credit each of the expense accounts. And then, as we talked about, debit income summary for the amount of its balance, which will be net income, assuming revenues exceeded expenses. And then that will get closed out to owner's equity, owner's capital. These are the illustrative entries shown with debits and credits for those 4 steps that we just talked about. That was step 1, is closing out or clearing out the revenue items. Step 2 was to close out the expenses. Step 3 was then to transfer that net balance and income summary to the owner's capital. And step 4 was then to close out the drawing accounts if there were any. The post-closing trial balance is basically what your balance sheet is, because if you've closed out your temporary accounts, revenues and expenses, and closed them to income summary, and then you've closed income summary to owner's capital, you do a post-closing trial balance, and that by definition is your balance sheet. And there we have the balance sheet as of a point in time, December 31st. And there you see your debit balances, which are your assets, and your credit balances, which are your liabilities, plus your owner's equity, the capital. And you are in balance. The accounting period adopted by any business, it's called its fiscal year. Most businesses will adopt the calendar year as their fiscal year, and I would say that percentage is somewhere certainly north of 80% of businesses. I've worked for several businesses. I actually tend to be specific since I got out of undergrad, and I've audited lots and lots of businesses, and I can tell you that in my experience, it's probably closer to 90% of businesses have a fiscal year that's the same as the calendar year. But there are times when they'll adopt a fiscal year that ends when their activities have reached a low point in the annual operation, and then that will then be a natural business year, and those will be businesses where the fiscal year is not December 31st, but it's somewhere maybe January 31st, maybe it's March 31st, maybe it's September 30. There are all kinds of cutoffs that you'll see when they have a natural business year. And the best example of that would be a retailer. Obviously, retailers have the majority of their businesses happening in the months of November, I'd say late November, after Thanksgiving, and then December. And then, of course, they're going to have some of those returns that also need to be net against that revenue that they had in December with all the Christmas shopping. And so many retailers will have maybe a January 31st or a February 28th or a March 31st fiscal year. And here's a table that the authors of your text have shown where you've got different year ends. Again, this is not a proportionate sample because, as I said, the majority of companies will have a December 31st year end. Now I want to revisit a slide that was led off actually in this presentation, and you've seen this several times now, that shows the income statement for a period of time that is explaining the difference in your equity between your beginning of the period and the end of the period. Now, another thing we mentioned, the history of the business since it started, you will have year over year, you'll have a balance sheet that you snapshot at the end of each year. And what caused that balance sheet to change? Well, it's represented in the income statement because the equity you hope is going to go up, and as equity goes up, so go assets, because hopefully you're growing assets as you're making money, and you'll see that reflected then in each year's balance sheet. So here we're just showing year over year, how did we change, and that's obviously represented by the net income of each period. Thank you. Okay, that was a lot to digest, I understand. Chapter 3 really was the more difficult process, because once you have adjusted with all the deferrals and accruals that you need to make, you've adjusted your revenue and expenses by creating a liability or an asset, which is what the accrual process is all about. The closing process in an accounting system is really done with the punch of a button, the stroke of a key. We still teach accounting using a manual process like we're doing now, as if you had to make all these entries to these accounts and flow them through income summary so that they close out to owner's equity at the end of the period. Thankfully, the computer does that in an automated fashion, and but we still teach it the old-fashioned way. So hopefully this made sense to you. But the more troublesome thing, I think, was deferrals and accruals. And if that was okay with you, then the closing process is no big deal. Congratulations, and I can't wait to move on to more interesting topics. Thank you.